morning everyone, and a very warm welcome to Virtual Think Tank 2022. Earlier this month we hosted more than 100 people at the Stationers Hall in the City of London for our annual Momentum Global Investment Management Think Tank Investment Conference, back in person for the first time in 3 years. We've always attracted a broad global mix of clients from around the world to Think Tank in the 21 years we've been running it, but the need to host it virtually over the past 2 years highlighted how we could very effectively broaden out attendance to the many hundreds more who would like to have participated through this, our virtual events platform. I promise you it's not as good as being a think tank in person, but surely is the next best thing. Over the course of 3 mornings, starting today, you'll be able to watch all of the presentations from Think Tank here, and we'll be able to interact live with both the MGym team and the speakers themselves through the chat functionality. In a moment, I'll hand over to myself for the opening of the in-person event and a more complete introduction, as well as a preview of the speaker lineup. Just before that, a few housekeeping points around our virtual platform to get the most out of it. The platform provides the ability to ask questions during the presentations. Members of my team, and in most cases the speakers themselves, will be on hand to chat and answer your questions that way. For South African viewers, please add your ID number, and for UK viewers, please add your advisor firm FCA number to the CPD section to earn the points allocated. There's no need to do anything else, as the system will automatically verify the time you watched. The virtual platform will remain open until the end of October if you'd still like to view any of the presentations you weren't able to see. Delegates will also still be able to get CPD points during this time. After October, all the videos will be available on our events page, on our MGym website, momentum.co.uk, as well as on the Global Matters portal and WhatsApp bot. Thank you very much for joining us today, and I hope you enjoy the first day of Virtual Think Tank 2022. Good morning everyone, and a very warm welcome to Think Tank 2022. My name's Andrew Hardy. I'm the Investment Director at Momentum Global Investment Management. It's been 3 years since we were in this same hall for the last in-person Think Tank. I'm pleased that we've been able to continue Think Tank virtually since then, expanding attendance to over 1,000 people in the process, but I hope you'll all agree it's a lot better to be back in person. Great to see so many familiar faces as well as plenty of new ones. Many have come from as far and wide as South America, Australia, Indonesia, Hong Kong, and of course our other home market of South Africa, visas permitting. Whether you've come from near or far, thank you very much for making the effort and taking the time to join us here. This is our 21st Think Tank, and also a belated opportunity to celebrate last year's 20th anniversary landmark in person this time. We're proud to have built and maintained such a strong following and reputation for this conference over the years, demonstrated by some clients having attended almost every one over the years, quite incredible. We look forward to celebrating these milestones with you this evening at the very special dinner venue of St Paul's Cathedral. Once again, we have an exciting lineup of top-level speakers sourced globally from across the investment industry to provide you with unrivaled thinking on the issues you face when advising your clients on investments. We're certainly not short of a few things to discuss. But for now, I would just like to take a couple of minutes to set the scene for the day and a half ahead. Firstly, a quick recap on our business. Momentum Global Investment Management, or MGym, was set up 24 years ago to run the international assets of our parent company, Momentum Metropolitan Holdings, one of the largest insurance and investments businesses in South Africa. Today, that remains a large part of our business, but over the years we've grown our third-party client base, working with leading advisors and wealth managers like yourselves from around the world, such that it now represents over half of our approximately $5.5 billion assets under management. The biggest development in recent years was the acquisition of Seneca Investment Managers here in the UK towards the start of last year, which was an incredibly well-aligned business to ours and complementary in so many ways. The whole team and business was swiftly and fully integrated, resulting in a much larger UK client base, a wider suite of solutions to support our growth ambitions here, and significant strengthening of our teams to the benefit of our entire client base. Our 19-person strong investment team is based across London and Liverpool, and given the experience, continuity and focus across the team, I think is incredibly well equipped to deliver on the outcomes we target across those portfolios. We focus on running
diversified, multi-asset, multi-specialist solutions, all anchored by a consistent, outcomes-based investment philosophy. The shocks of the pandemic and this year's turbulence have tested our philosophy to the extreme, but our tried and tested approach has repeatedly demonstrated its resilience and delivered excellent performance to clients. And this has been built around the core foundations of a long-term valuation-driven approach, deep proprietary research, and true portfolio diversification, which, in my opinion, it's the consistency and conviction, there we go, with which we implement this, along with our focus, that sets us apart from so many others and makes us such a valuable partner to your business. Within MGIM, we also have an institutional consulting business based in Windsor, which has approximately £30 billion under advice on behalf of a number of defined benefit pension plans for large blue chip businesses. It's a long-established team, and they've enjoyed a lot of success over the years, and most recently was ranked first for overall quality in the Greenwich Institutional Investor Survey. Further to that, many of you will be familiar with our sister company within the group, Momentum Wealth International, which operates a Guernsey-based investment platform. MWI offers a cost-effective open architecture platform, which is well-suited and increasingly relevant for today's needs of advisors and their clients. Onto the event itself, Think Tank provides an ideal lens into our approach within our fund management business. We've always named the conference as such to reflect the focus on delivering serious and value-additive investment thinking from a host of industry experts around the world. We focus on what lies ahead rather than what's been before, so that you can use the content to shape your discussions and strategy with your clients. No different this year, as we bring you an agenda of 17 speakers, the majority of which represent the specialists we partner with in various capacities within our multi-asset solutions. And the speakers are the decision makers themselves, the CEOs, portfolio managers, and founders that are ultimately responsible for your clients' assets. Theme this year is a year of transition, investing for resilience. When we set this around the beginning of the year, we already thought that 2022 would prove a more challenging year than last year, but it's certainly exceeded our own and most others' expectations on that front, driven in particular by the impact of the consequences of Russia's invasion of Ukraine. This has, of course, poured fuel on the inflation fire, which was already burning brightly, and which we and most other speakers last year highlighted would have such wide-reaching consequences across markets. And we now have a more challenging growth and policy backdrop than we faced for many years, with stagflation and recession fears driving huge uncertainty across market participants. Growth is undoubtedly slowing rapidly and may well tip many economies into recession before long, if some, including the all-important US economy, isn't there already. But the magnitude and duration of the contraction is very difficult to gauge, along with the consequences for asset class returns. These themes will permeate through all of the presentations, but with a diverse mix of speakers specialising in very different areas of investment management, we expect no shortage of distinct views to be shared. There'll also be many more bottom-up, company, country, or industry-specific insights that will highlight just how much room for nuance there is beneath the surface and the value that can be derived from partnering with the world's leading specialist active managers, which we believe will prove ever more important in these more volatile times. In this, our 21st year, I think we have one of, if not the best speaker lineups we've ever had. This includes Greg Fruzesi of JP Morgan and Gurpreet Gill of Goldman Sachs, both macro strategy specialists who will focus on the top-down forces buffeting the world economy and the outlook from here. Mark Baraboo and Patrick Meegan from Jennison Associates and Hotchkiss and Wiley, respectively, both visiting us specially from the US, but with highly contrasting growth and value-oriented approaches to investing in global equities. Wilma de Groot from just across the North Sea at Robeco in Rotterdam will argue the case for both styles and more, as well as her team's approach to sustainable investing, which is the engine for our Momentum Global Sustainable Equity Fund. Continuing that ESG theme, we'll hear from Ashish Swarup of Aikya Investment Management on how to identify the sustainability and impact leaders in emerging markets. Also, Gareth Jones of Alvaran Partners, managers of Home REIT, a residential property portfolio delivering strong inflation-linked returns to investors whilst helping to address the homelessness crisis here in the UK. And Giles Frost of Amber Infrastructure, whose FTSE 250 listed INPP trust of infrastructure assets has been one of several sources of stability within our portfolios this year. Fred Ingham of Neuberger Berman will highlight another very different source of stability through his liquid hedge fund strategy, which represents one of the best performing holdings across our portfolios this year, delivering uncorrelated returns true to its objective. Tom Norton of Prusik Investment Management will present on his Asian income strategy, a large and long-standing holding across many of our portfolios, which has performed exceptionally well over the long term, particularly through more difficult markets, including this year. And we'll also hear from specialists in some of the most challenged corners of markets, who will highlight the significant value opening up in places as this cycle develops. These include Tim Creed of Schroders Capital, manager of the SUP-listed private equity trust, who will be accompanied by Tim Sadler of Tessian, the CEO of one of their underlying portfolio holdings at the end of the day today. Also, Gustavo Medeiros of Ashmore, who will discuss the outlook for Chinese property and debt markets, as well as broader opportunities in emerging markets debt. All of these specialist managers are represented across our portfolios to varying degrees. As well as thought-provoking discussion, we hope hearing directly from these managers will highlight the many advantages of our multi-specialist approach, which brings together so many of the world's leading investors in a single portfolio. My colleague Alex Harvey will talk through how we go about combining them within our solutions, harnessing their skill and return potential while ensuring deep and robust diversification. Joining us from South Africa, Paul Nixon, who leads our behavioural finance team, will present on the equally challenging and intriguing angle of investor behaviour, focusing on differences across generations and personality types. You'll find a teaser from him in your delegate packs. Unfortunately, in a late change, Jeanette Murray, Deputy CEO of our group, wasn't able to join Paul and our other colleagues on the flight over. So in a change to the agenda, we'll hear from Martin Rickett, Executive Head of Retail Investments, instead for an update on our business. And concluding the conference, as ever, piecing all these expert viewpoints and insights together will be my colleague Glyn Owen, who requires no introduction to most of you. So lots of speakers, but all in bite-sized slots of 20 to 30 minutes. The more interactive we can make it, the better. We'll make sure there's a few minutes left over for questions at the end of each presentation. I've prizes on offer for anyone who managed to ask more questions than my friend Andres over there. I hope you all enjoy the conference. Once again, thank you very much for joining us. So now, without further ado, I'll hand over to our first speaker of the day. Greg Fuzesi joins us from JP Morgan, where he is a Euro area economist. Past attendees may recall presentations from his colleague Malcolm Barr last year, as well as David Mackey before that. The economic backdrop in Europe could hardly be more complex between the war in Ukraine, looming energy shortages, soaring inflation, and rapidly slowing growth. Central banks around the world have an incredibly challenging task in their fight against inflation, none more so than the ECB, which is expected to some extent to agree a record 75 basis points hike in interest rates tomorrow, potentially. So Greg, no doubt, has a lot on his plate, so we very much appreciate you taking the time to join us today. Over to you, Greg.
So first of all, thank you very much for having me. I head up the Euro area group at JP Morgan, responsible for the overall growth and inflation forecasts and also the ECB call. And one of the things I've been saying in recent months when I start talks like this is that this is a truly remarkable time. I mean, we have gone through one crisis after another, from the financial crisis to the sovereign crisis, trade wars. I would include Brexit in that. But this is the first time that we are being hit by multiple shocks at the same time and going in to some extent in opposite directions. So trying to pin down forecasts and an outlook is incredibly difficult, not just for us, but also obviously for policymakers themselves. And this is the kind of thing I was saying 2 or 3 months ago when gas prices were, moving through the €100 per megawatt hour level. And then 10 days ago, we were leisurely going up towards 350. So this is even more true right now. It's just an incredibly volatile time at the moment with massive shifts going on in the global economy. And that's the kind of message I want to try and convey. Now, I hope this works. Yep. Okay, so the first thing, just a few words about where we are globally. You can see on the left-hand side, there's kind of a probability decision tree, which is trying to send a message or convey our thinking about where we are in terms of global recession risks. And you can see that when you start off on the left-hand side, you either go left or you go right. And our judgment is that you go right, but it's a close call. So the baseline has kind of ongoing recovery in the global economy, but there is a risk of a stress-induced global recession already in the second half of this year. So things to note there are obviously the Euro area or Western Europe with the whole gas shock. You also have the zero COVID policy in China, which is still causing issues in terms of management in an environment where vaccine take-up or effective vaccine take-up is still quite low. And we've also had recession fears in the US in terms of the Fed tightening rates, pushing up market interest rates, slowing the housing market, and some of the data were flashing quite red a few weeks ago. Now, in terms of the second half of this year, I would say at the global level, things have probably improved overall, but there's been a rotation with recession fears in the US, at least imminent ones, receding. China also bouncing back from the earlier lockdowns, but then recession risks and recession itself actually going up as a risk in Western Europe. So there's been a regional rotation in terms of the second half of this year. Now, if you then follow the path towards the bottom, you then have another decision tree or a branch in 2023, 2024, which is where the bad outcome relates to central bank induced recessions. So this is the whole debate about whether the inflation outlook has become so difficult even for the medium term that central banks actually need to cause some damage to their economies in order to push unemployment up and reduce medium-term inflation pressures. So even if you get through the next 6 months, there is still a question about the landing zone and what do central banks have to do in terms of slowing things down and even causing like monetary policy induced recessions to ensure that inflation does actually return to 2% rather than just to 2.5% or something like that. Now there, you can see it's more of a 50-50 call, especially as you extend the time horizon forward. So 2023, 2024, our judgment is that there is almost a 50-50 chance that you have to have a central bank induced recession. So the single most likely outcome is basically a recession later on or a soft landing. But it's obviously you've got issues both in the second half of this year and further out. So it's definitely a difficult outlook. Now, in terms of the regional rotation, I mean, the chart at the top right-hand side makes that incredibly clear, where if you look at energy prices, so indexed to 2018 levels, you can see that oil prices have gone up significantly. US natural gas prices have also gone up significantly, but nothing compares to what we're seeing in Western Europe. So clearly this is a big regional shock that is justifying if you look at the bottom right-hand side, a weaker growth forecast in Western Europe with some contraction in the fourth quarter and the first quarter of next year. So I'll spend a bit of time just going through the way that we're thinking about the Western European side of this, focusing in particular on the euro area, and then I'll say what the implications are for central banks from that. So the first this is just a table which shows the forecasts. So -2% annualized contraction in Q4 and Q1, an unemployment rate that at the moment is at a record low of 6.6%. It goes up to about 7.1, or half a point up through to the early part of next year, but then improves again because growth resumes. You have headline and core inflation, which are incredibly high. We're likely to go through the 10% barrier in the coming months. But then, unless energy prices have another leg up, from an inflation perspective, the price level will be permanently higher, but the inflation rate will come down because that looks at the change in the price level from one year to the next. So there is still the prospect or the forecast that inflation settles around the 2% target at the end of next year. But from the ECB's perspective, and apologies, this doesn't have one extra hike in there, you're clearly in the wrong ballpark if you have your policy rate at 0 at the moment. So between now and the end of the year, I think the ECB will have to raise rates to about 1.5%. Then it can probably pause, become a bit more growth sensitive, but then resume and raise rates to all the way to 2% in the second half of next year, just to complete the normalization job. So this is just an overview of the euro area forecast. Now, the big near-term issue is obviously gas. And this is sort of where all efforts to try and put together a forecast start and get stuck. Because pinning down what the gas price will do in the coming hours even, is incredibly difficult given the huge volatilities that we've seen. Now, economists have spent quite a lot of time trying to estimate the impact of oil or gas shutdowns from Russia on the economy. And the impacts are clearly very large. Top right-hand side, this is from the German Bundesbank. You can see that the level of GDP, and this was done in June, so timing-wise things are obviously shifting, but if you have a shutdown of Russian gas kind of in June, which we didn't, but let's assume that we had that, the level of GDP on their estimate would have fallen 5%, a bit more than 5%, already in 2022. Now that's a massive decline, given that it has to come in the second half of the year. And half of that, you can see the bar at the bottom, the kind of the blue bit with the lines through it, that is the impact of gas rationing per se, where the regulator says, we're shutting down the chemical sector, we're shutting down the metal sector because they're using too much gas and we need to save it for the winter. Later on, you still have huge drags. So GDP, in their estimate, only recovers to 3.5% below the baseline in 23 and 24, because you still have the reverberations of the high energy price working its way through the economy, through uncertainty effects, purchasing power effects, and so on. And on inflation, at the bottom right-hand side, despite the massive collapse in GDP, their judgment is that inflation will still be higher even in 2024, even though a weak economy should really be reducing inflation pressures. So this is clearly a very, very difficult kind of setup here. Now, I have actually shied away from putting numbers on what the effect of shutdowns of gas flows could be. And the reason is that I think that this is actually a very fluid situation, because it matters hugely when you shut off the gas. Most people would not have expected German gas storage to be 86% full today or yesterday, even though flows through the Nord Stream 1 pipeline have already been running at only 20% of normal capacity, and have now been shut down completely. So there's no more gas flowing from Russia at all. And nevertheless, Germany has managed to fill storage up to 86% of capacity. Now that covers a quarter of your annual consumption if you take your storage from 100 down to 0. You'll never do that all the way because you never want to be at 0. But it does cover a couple of months in the winter, and you still have flows coming from Norway. Germany is about to put in place mobile LNG import terminals, which also creates capacity to import natural gas, equivalent to about Nord Stream 1 running at 40% capacity. So the situation, in these estimates is you shut down the gas, you struggle to come up with any alternative, and then you work through your macro models, your input-output tables, and you just slash everything down in terms of output. But what we see is that the economy is actually a lot more flexible and adaptable to the situation, and policymakers have actually been quite successful at getting alternatives. And similarly, on the manufacturing side, 3 or 4 months ago, you had many sectors who were saying, well, we use gas and we have no alternative. And now some of them are saying, well, actually, we might be able to heat our furnaces with electricity. And these things do matter massively for what the impact of the shock would be. Now, just to put a bit of scaling on this, if you look at the chart at the top left-hand side, you can see that for a region that imports energy, you can look at the cost of the gas crisis in terms of your import bill. So how much more are you having to transfer abroad to get a certain amount of gas coming into your region? And you can see that the import bill for energy overall had fallen to about 200 billion in 2020, early 2021, which is about 1.5% of euro area GDP. And that looks like it's going to be shooting up to about 900 billion. So you're going from a situation where you're transferring 1.5% of your production value or your income abroad to get energy, and now you're having to transfer something like 7% abroad, 7.5%. Now, you can picture that in terms of your own personal finances, just giving up an extra 5-6 percentage points of your income, and then seeing or imagining what you're going to do to adjust your spending. So it's a massive, massive shock. Now, this is why we have a forecast of recession at the turn of the year. Now, the best we can do at the moment, given the uncertainties, is basically track where we are. Now, what I would say just very briefly is if you look at the top right-hand side, and this area here is very, very messy because of the pandemic, but if you look at before, there's a good correlation between one of the main business surveys, which is the PMI survey, the orange line, and quarterly GDP growth. And you can see that there's been a significant weakening here, but the survey at this point, and this is August, is still pointing to some modest growth in the euro area economy. So recession risk, yes, but it's not yet in the data. Now, what we can already see is, for example, if you look at the two charts at the bottom, you have energy or gas usage in German manufacturing, which is running something like 10% or so below the average of recent years. And you can see in the IP data that the energy-intensive parts of German manufacturing are already underperforming the rest of the sector, with cars being on a slightly different planet because of the semiconductor shortage issue. But you can already see a difference in performance of energy-intensive and non-energy-intensive parts of German manufacturing. Chemicals in particular has declined in terms of output, and chemical imports have increased. So you're substituting domestic production for imports. Now, on the more consumer side, or just one last thing on the top left-hand side, you can also see a massive divergence in some of the surveys between, so this is in Germany in the IFO, between what companies are saying about their current situation, which has not really changed all that much, and their expectations, which are a complete disaster. So, the next 6 months they think will be really difficult, but they're not actually seeing that much of an impact just yet. On the consumer side, it's similar. If you ask consumers about their personal financial situation and their expectations for the economy, it's basically down here, even worse than during the pandemic. But in terms of people's view about the labor market and job security, it has weakened, but not really all that much. So even there, it's a bit more differentiated. Euro area retail sales, they are weakening, but from a very high level. And even if you take the headline measure of consumer confidence, you are looking at consumer spending falling at a 3% pace only. But as I say, there are some issues about the composition here. Now, just again to provide a bit of a balance, there are also some positives still working their way through the system which are affecting the forecast. So the first is that we have not yet seen in the published data the full extent of the post-COVID rebound. There is still more to come, especially on tourism. In Spain, hotel stays are kind of back to normal. But if you look at US air traffic to Europe, there is still a wave of US tourists set to come over and give the tourism sector a further boost. We also have the situation of very, very high savings rates that we saw during the pandemic, where you simply couldn't spend on certain things. You couldn't go traveling, you couldn't go and do leisure services, and there were only so many computer screens that you can buy to compensate for that. So effectively the household sector ended up cutting consumption, but disposable income actually held up much better, so you had abnormally high saving rates. And if you add up the excess savings that were made during the pandemic, they amount to something like 12% of disposable income. So again, the economy is having to transfer 6% of income abroad extra to get energy, but households have had a kind of an injection of 12% of their disposable income of cash, which is still sitting there somewhere. It's obviously not evenly distributed and all the rest, but it's not like that the starting position is a complete catastrophe. There's also positives in terms of the labor market. I mean, top left-hand side, employment in the euro area is above the pre-pandemic level. The recovery has been stronger than in the US. Unemployment is at a record low without any assistance from a fall in the participation rate. Companies are complaining about labor shortages. And I think we've all experienced the practical impact of that at airports over the summer. But it does mean that there could be reluctance on the part of companies to let people go because they will be worried about the difficulty of rehiring if the shock abates at some point. And that gives you a bit of resilience in terms of the labor market adjustment, and in some sense consistent with the strength in the labor market. At the bottom left-hand side, there has been a pickup in wage growth, which is also generating income for households. So, if you look at disposable income in real terms, it's flatlining, but that already includes a big inflation drag, which is to a large extent offset by a real acceleration in the nominal disposable income that households are earning. Now, this will obviously get worse because these are, data through to the first quarter, and there's more inflation pressure to come. But again, there is a lot of income being generated by the labor market that is helping to some extent. Another thing to watch is manufacturing, again, on the positive side, in terms of the bottlenecks issue from the past. If you take the German data, you have had, a 2-year period where the level of industrial orders was running much higher than the level of production. And the flip side of that is that you've had a huge run-up. So you've had a huge run-up in the backlog of orders. So again, manufacturing is facing big pressures from the rise in energy prices, but it is sitting there with record levels of order backlogs that still need to be worked through. If you take, for example, Volkswagen, they announced, I think 3 or 4 months ago, that if you want to order an electric VW, you have to join the queue for 2023. So again, that provides some scope for the industrial side to continue to grow if some of the older bottlenecks actually ease. Now, again, I don't think that will offset the drag from the energy side, but it does mean that the drag overall will be less because you've got other positive dynamics still working their way through the system. The basic point that I would like to make on inflation is that at the moment it clearly is a very, very difficult situation with inflation at double digits. In the UK, some people are now saying it could be 15, 16, 17% in terms of where you peak. But I still think this whole debate about transitory versus permanent is not yet completely dead. And what I mean by that is if you look in the decomposition of the inflation basket on the core side, you essentially have core goods where everything is going crazy. You have car prices, bicycle prices, furniture prices, everything has gone through the roof because demand has been strong and supply has been very weak. And in some cases, the cost side has also been going up. So wood prices have boosted furniture prices. This is what I'm talking about. You are massively out of any historical range in terms of core goods inflation, irrespective of which item you look at. Now, on the services side, there are similar charts. Accommodation prices, so hotel prices, restaurant prices, even rental inflation is starting to nudge higher. So you might very easily conclude, well, this is a very broad problem. And therefore, central banks necessarily have to go into restrictive territory and really slow things down. And there's, you can make that argument also based on some more sophisticated measures of underlying inflation, which is at the right-hand side, top right-hand side. But what I would say is that a lot of these older measures of underlying inflation are not really that well suited for the pandemic context. So the two things that I look at instead are bottom left-hand side. It's a bit messy and you need to have a bit of goodwill to see the correlation, but there is an impact of high energy prices on core inflation, and it's not small. When energy prices go up, airfares get more expensive, transport prices go up, and so forth. So in the core basket, when you're sitting there and you're thinking, okay, core inflation is 4.3%, I would say, yes, some of that does, however, include pass-through from high energy prices to core. The second is if you decompose the services basket into items you can link to the pandemic and other items, and the other items are basically 75% of the services basket, you see that here on the services side, it's still much more lopsided. That the non-pandemic inflation rate has only just gone above 2%, and the pandemic-related items are running at sort of 7%. This is where hotel, restaurant prices and airfares and package holiday prices come into it. So I would say that the extent to which the euro area inflation data have gone over the top is still more limited than it is, for example, in the UK and the US. Now, let me finish on the central banking side. Clearly, as I said at the beginning, whatever your interpretation of the near-term outlook and the inflation data, it is not the right place for the ECB to have the policy rate at 0. I think just from a credibility perspective, I think some people need to be shown that the central bank is on the case. Of course, raising rates is not the solution to the gas crisis, because that doesn't miraculously get gas more cheaply, and you're actually hitting other parts of the economy to compensate for the pressure. So you're using the wrong tool in some sense. The real tool is fiscal, or a ceasefire in some way in Ukraine. But you're still having to demonstrate that you're doing something and you're moving away from these very, very low rates. So for the next 2 or 3 months, I think the ECB does need to further raise rates, to reestablish its credibility. I would say that inflation expectations in the euro area as well are not yet unanchored. So the ECB hasn't yet kind of let things go too far on the upside. I do think that the recession or downturn over the winter will have a dampening effect on wage and price setting. It will take some of the froth out of pay settlements that are due to be done later on this year, which I think will give a bit of reassurance about the medium-term inflation outlook. And therefore, I don't think that inflation will necessarily settle above 2% at this point. Now, there are clearly a lot of other issues that some of the more hawkish members worry about, which is longer-term inflation pressures coming from climate change, the green transition, demographics at the global level, deglobalization, and so on. So there's enough there to keep you, in some sense, up at night if you are worried about upside risks on inflation. And therefore, I think, even if you become more growth sensitive during the downturn, you will have to raise rates further later on, especially because I don't expect a huge damage to the labor market from the downturn that we are likely to see over the winter period. So rates are set for normalization, but in Europe at least, or in the euro area at least, I'm not yet convinced that they have to go into restrictive territory to really cause damage to the economy to hit the medium-term inflation target. That is a bigger debate in the US and the UK, especially with fiscal policy in the UK also set to provide a big offset to the gas drag. Now, in terms of balance sheet policy, this also argues for quantitative tightening. Now, I think this is already obviously happening in the US. It's happening in the UK. Again, I think euro area is a bit different because you've got Italy. So the ECB needs to be more careful in terms of what it does with the balance sheet to compensate for that. But the policy rate is effective at still making sure that your stance is at the correct level. So even though the ECB will be more cautious on the balance sheet, I think it will be able to set monetary policy at the right level overall. And I'll stop there just in the interest of time.
Hi everyone. I'm really pleased to be able to introduce the next speaker, Tom Norton from Prusik Investment Management. Tom is managing partner and CIO of Prusik, and he is portfolio manager of the Prusik Asian Equity Income Fund, a fund he has managed since its launch in 2010. Today, Tom's going to talk about Hong Kong and its evolving relationship with China. I think the topic is an excellent way of understanding how markets price risk, particularly in relation to China, and how this creates interesting opportunities for bottom-up active managers. So Tom, over to you.
morning. Thank you for having me. I'm Tom Norton. I'm the CIO, Managing Partner of Prusik Investment Management. We're a Asia equity boutique, and I also run the Asia Equity Income Fund as part of my role here. Today I'm just going to talk a little bit about Hong Kong and China and the relationship between the two of them, because I think in many ways people, merge the two markets, and in my view there's much more, there's much more finesse that we need to really, when we talk about China and Hong Kong, we can't just include them together. I mean, Hong Kong equities have been a terrible place to be for the last few years. You may remember in the middle of 2019, we had the beginning of the protests or the riots, and that led to a big clampdown in Hong Kong. And then that moved seamlessly into COVID in the early part of 2020. And since then, Hong Kong has really been, in some sort of lockdown for the last 3 years. So straight from political unrest, the implementation of the national security law, which caused a lot of concern in terms of the way that, the power that it gives the Chinese government to prosecute people. Concerns over one country, two systems, that it's just turned into one country. Concerns about the COVID policies, both in China and in Hong Kong, and what that means for Hong Kong operating as a global city. Geopolitics, this big question of, is China uninvestable? Is China in 2022 the same as Russia in 2021? It's just, it's about to be sort of cut off from the global financial system. And then finally, although it's maybe not as big an issue, but Hong Kong also, the mix of companies have been very unfashionable. You can think of it as being a bit like the FTSE 100, lots of sort of conglomerates and banks and real estate companies and companies that just aren't very, haven't been very popular in the last few years. So that's really led to this, huge derating and a huge amount of pessimism about Hong Kong and China. And the question is, does this derating, does this represent the end of Hong Kong? Is that it? We should just sell and forget it? Or is it, a generational buying opportunity? Hong Kong's been through many of these occasions in the past, after the riots in the 60s, after Tiananmen in the late 80s, after, just when I started my career, which was in the few years before it went back to Chinese rule. At each time people say, this is it for Hong Kong, it's all finished, but Hong Kong has shown incredible resilience, and in the past, at times like this, has always been a good opportunity to buy. But of course, there have been significant changes, and so, will Hong Kong become just another Chinese city, in which case it's much less interesting. And for equity income investors, it's particularly interesting because there are a lot of very high quality dividend paying stocks in Hong Kong. Hong Kong has a very long history in paying dividends. For residents of Hong Kong, dividends are obviously tax-free, and so it's a very efficient way of upstreaming cash, and there's always been a very big dividend culture. Just talking a little bit about dividends, this is just the dividend yield of the Hang Seng Property Index. You can see there right up to the highs. And bear in mind, a lot of these companies, we can find companies that are, investment grade, single A minus rated companies with dividends that are still growing, that are buying back shares, that are trading dividend yields of 4 to 7%, which I think is extremely attractive. And just on the market more broadly, the Hang Seng Index is trading at 0.8 times price to book. Now, I started my career just on the far left of that chart at the peak in 1994, and obviously it's derated significantly since then, but just to put it in perspective, Russia is on 0.7 times price to book and Hong Kong is on 0.8, so simplistically we can argue that it's discounting close to the worst case scenario anyway, even though that hasn't happened yet. And again, we can find companies with good business models, paying good dividends that are trading on 30 to 50% of book value. And as we say, outside Russia, it's very difficult to find value like that. When it comes to Hong Kong and thinking about Hong Kong's place in the world and its status, my view is that the concerns, although they're understandable, are misplaced. China needs Hong Kong to prosper in order to access foreign capital. They've made this very clear. We're seeing this now with the ADR listings moving back from the US to Hong Kong. Every policy measure that China puts in place is to support Hong Kong as the offshore financial center for China. And there's really no alternative. Until China have a freely floating currency, they have no capital controls, they have a legal system that people trust, They have no acts, they have no alternative to Hong Kong. And also, China believes a successful Hong Kong is good for future negotiations with Taiwan. Now, this isn't something that people in Taiwan think, but you may remember Hong Kong was actually in a way, the sort of blueprint for Taiwan, this idea that Hong Kong gradually becoming part of China in this one country, two systems was going to be a template they could use for Taiwan. Now, obviously what's been going on in the last few years, attitudes in Taiwan towards independence or towards, have obviously increased, and people's trust of the Chinese government has decreased, but still China believe, and I think with some justification, that the more successful Hong Kong is, the better it is for future negotiations with Taiwan. Obviously, they don't want to have to use military force. The more they can do it with showing that Hong Kong can be a success, the better it is for them. And as I say, the Hong Kong dollar peg, I think every few years there's a hedge fund manager that publishes something on the Hong Kong dollar being a short, but I think it's extremely unlikely before the renminbi becomes fully convertible. It's impossible to break because it's a currency board, so it can only be broken by choice. It's not because it's a full currency board. There's no way of breaking it until you need Hong Kong to actually sort of give up. But I think that peg is going to remain. I think that's another concern people have. The other point is Hong Kong, I think, has a lot more autonomy than people realize, although less than it did a few years ago. So on his recent trip to Hong Kong to celebrate the handover, the 25th anniversary of the handover, Xi's speech highlighted the benefits of Hong Kong's differences. In fact, specifically, for the first time I remember him doing, praising the common law system. People can be skeptical about that, given what they're doing on the criminal justice side, but I'll come on to that in a little bit. But I think China can see that it's very useful from a business perspective, having a legal system that if you're doing foreign investment or you're setting up businesses, works extremely effectively, being based on common law. And it doesn't really suit them to get rid of that, to make Hong Kong just like another city, because it comes back to Hong Kong's place in China. It's very important that they maintain those, those things like the legal system that allow it to operate. Also, although people suspected that Hong Kong would just have to follow China's COVID policy, Hong Kong's COVID policy is now effectively moved to living with COVID. They're adding 10,000 cases a day, which would be in UK terms 70, 80,000 cases a day equivalent. So there's obviously, COVID is now endemic in Hong Kong. There's very few restrictions in Hong Kong apart from the quarantine. And so Hong Kong is talking about getting rid of quarantine completely. So in that sense, Hong Kong is being allowed, despite many skeptics, to have a completely different COVID policy. And something else which I think is interesting, that Hong Kong banks abide by the US sanctions. You may remember the US sanctioned a lot of Hong Kong officials, including the chief executive, Carrie Lam, so she couldn't have a bank account in Hong Kong. She had to be paid in bundles of cash. And it's quite incredible to think in what's being part of China, the Hong Kong banks are actually abiding by the US sanctions, even though in China they're forbidden to. So I think it's clear in terms of what's happening, what's being said, the policies that are going in place, that China want to have Hong Kong being separate and having a different amount of autonomy. So the strengths remain intact. The ease of doing business, it's still ranked third in the world in last study in terms of the ease of doing business. Low taxes, very good infrastructure, free movement of capital. Obviously, the COVID restrictions remain a huge issue. We can't pretend they're not. But other than that, a lot of the strengths remain. And in a way, I think, slightly provocatively, as someone, I lived in Hong Kong for a long time, when people talking about Hong Kong, moving to Singapore, I think, well, you may have noticed there's not many protests or demonstrations in Singapore. This is a country that has a lot of restrictions on democracy, on free speech and human rights, but is economically very liberal and very free, but obviously controls certain areas very tightly. And I think China wants to do the same thing. When it comes to human rights, when it comes to foreign policy, obviously that will be something that does remain very sensitive. But when it comes to running a business, investing in China, even suing state-owned companies, that will be something that I think will continue much like it does in Singapore. Now, obviously people trust the Singapore government much more than they trust the Chinese government. We haven't seen whether this will play out in practice, but I think it's underappreciated how likely it is that that will happen. This is just a chart to show Hong Kong's resilience here, and what these charts show are the movement in property prices and then the movement in delinquency ratios. And you can see there, if we look at B and C, you can see the US and Ireland saw property prices fall 30 to 50% and delinquency rates went to this sort of 10 to 12% level when that happened. You can see in Hong Kong, where property prices fell by 2/3 and the delinquency ratio went just above 1%. And that's because Hong Kong, because it has a currency board, has always had to operate an extremely flexible economy. It has a huge amount of flex, both in asset prices, in wages, and the banking system and property companies are extremely under-leveraged, which gives it this ability to withstand a volatile situation. So I think it's something that, again, is underappreciated when it comes to Hong Kong. Just taking a little bit, moving on to sort of China. Now, China risk is a big topic. We can maybe address a little bit of that in Q&A, but the biggest risks I think people worry about at the moment are geopolitical, and at the moment it's China invading Taiwan, and the credit market or the real estate market, and whether that will cause a banking crisis or an economic depression. Now, if we think about the geopolitical risk, which I think is the one that people worry about the most, about China being uninvestable, my view is whatever you think of China risk, if you're bullish or bearish, if you're complacent or extremely nervous about it, China risk is priced very differently in different markets. So I give the example of Tesla. Their Shanghai plant is now 60% of their total production. And in an era, if we did see China, lots of sanctions being placed on China, that obviously has a huge risk for the valuation, which I would argue is not really talked about or discounted. Apple still manufactures most of their products in China, even though they're trying to move away. Still more than 80% of their products will be made there, and obviously 20% of their sales are to China. Rio, LVMH, BHP are obviously very, very dependent on China for their sales, and of course they will be significantly impacted by any types of sanctions or the lack of ability to trade with China. And Taiwan Semiconductor, which is a company that's very highly regarded, I think has very low risk priced in for anything that would happen on that regard. Whereas Hong Kong, where the risk premium, and I would argue, is the highest, is actually the place where the risk is lowest because it's already happened. The thing that people worried about, which was China effectively exerting control over Hong Kong, that's already happened, that's taken place. But I think from this point, it's one of the lower risk places to take on China risk, regardless of what you think. What could be catalysts and risks, and what could change people's view on this? I mentioned earlier, Hong Kong is still one of the few places that has quarantine and travel restrictions. They've moved it from 7 days hotel quarantine to 3 days plus 4 days home, and there's a lot of discussion in November of getting rid of that completely. Certainly, anecdotally, that's the reason a lot of people leave Hong Kong, is because it makes it effectively impossible to travel. Although the hotel quarantine doesn't sound too bad, just the cost and complexity of getting, and the lack of those hotel rooms means it's extremely challenging to travel. And for a market like Hong Kong, where people spend a lot of time going in and out, that's been a huge issue. So I think removing that would be important. An improvement in the Chinese stock market would be obviously very good, even though I've said Hong Kong and China are separate places. Hong Kong is the financial center for China, and so recovering China is extremely bullish for that. You can think of it as it's like Manhattan to the US or London to Europe. It's a very the financial activity is very important for the city. And in a way, China, although people are very depressed about China at the moment, there are some positive things going on there. It's one of the few markets in the world that has no problem with inflation, or very little problem with inflation. It didn't do the big QE and fiscal ease that Europe and the US did, so it's in a lot better position. If they did just get rid of their zero COVID policy, then the upside potential in economic activity is pretty substantial. And then a decrease in geopolitical tension, which obviously goes both ways. But I think the current geopolitical tension is obviously extremely high. People are extremely worried and nervous about Taiwan. I started my career, I say in 95, where China were lobbing missiles over Taiwan, and it was the same. People thought a war was imminent then as well. So it's something that certainly can rise and fall. And obviously another risk is that I'm wrong on this China allowing Hong Kong to operate separately, that they do get rid of the legal system, they do make it just another Chinese city. You know, I would argue much of that is in the price, but obviously that's not going to be positive for Hong Kong. And so just in conclusion, I would say I think fears that Hong Kong will become just another city are understandable and misplaced. The valuations are pricing in this very negative scenario already. And so I think for people that are, you know, willing to take on that risk, there's lots of opportunities there. I think the resilience and autonomy are underappreciated in Hong Kong, and particularly in an area of global uncertainty, having economies that are built to withstand a huge amount of economic volatility and interest rate volatility is a strength, and the upside potential from you know, normalization of travel and reduced political risk is significant. So I just end with this quote from GMO, which is, you make more money when things go from truly awful to merely bad than when they go from good to great. And I would say that's definitely the position Hong Kong's in at the moment. So I'll leave it there and see if you've got any questions.
So we've heard just how much the market environment has changed over the last year, and part of that change has been a welcome revival in value investing. We've seen this year just how, yet again, value equities have proved defensive in a very difficult marketplace. Can this continue? To answer this question, we've invited our next speaker, Patrick Meegan, who is a portfolio manager at Hodgkiss & Wiley, a value specialist based in Los Angeles. And again, we thank him very much for making the journey over to London to see us today. So Patrick has over 3 decades of experience in the industry, and he's managed money through difficult periods like the dot-com bust. And the question now is, you know, are we in a similar period today, and what are the opportunities in value equities? And I'll invite Patrick on stage now to provide some answers to some of those questions. So, thank you, Patrick.
Thank you. I wanted to say good morning and thank you for the opportunity to offer our firm's perspective on value investing in the current environment. Our firm, Hodgkiss & Wiley, has a 40-year history as a disciplined, high-conviction value manager. Value investors purchase shares of companies where the present value of their future cash flows exceeds the current share price. The investment decision is made after a detailed study of the company and the industry in which it operates, and a careful consideration of risk, which we define as permanent impairment of capital. Value investors focus on companies that trade at valuation discounts to broad market indices. Valuation discounts typically occur because a company's current financial results are below expectation, industry and/or company issues, specific issues have arisen, or the business is misunderstood. Growth investors focus on companies trading above broad market valuation levels because a company's prospects look very strong and are expected to grow more rapidly for longer. Growth stocks historically have traded at higher premium valuation multiples relative to value stocks. I'll refer to that phenomenon in this presentation as the growth valuation premium. But in many cases, the growth premium proves excessive and reverts down. This reversion occurs because additional investor enthusiasm often, but not always, wanes as a new business develops, competitors emerge, and the risk inherent in new industries, business models, and products become clearer over time. Value investing isn't better or worse than growth investing. In our view, they are complementary. Many of our clients pair us with disciplined, high-conviction growth managers to generate consistent alpha across market cycles. Value investors rely on mean reversion and historical financial information, while growth investors find mean reversion exceptions and innovators that create new industries or disrupt the competitive dynamic within existing industries. The presentation today focuses on 4 key points. First, value outperforms growth over time. Second, the growth valuation premium today is very wide. Third, banking, energy, and software stocks look particularly attractive in this current environment. And fourth, European stocks trade at a large discount to US stocks, albeit with elevated risk. Empirical and academic studies have consistently demonstrated that value stocks and small capitalization stocks outperform over time. This chart shows the 58-year annualized performance of growth and value stocks bifurcated into large and small market capitalizations. The data source is Fama in French, the academics who first identified value in small cap growth market anomalies, and is among the longest value or investment specific data sets that are available. Value has outperformed growth by 170 basis points annualized for large caps and by 650 basis points annualized for small caps, again, based on the Fama and French data. Value's outperformance has been attributed to many factors, but in our view, it's driven by investors' tendency to over-extrapolate recent business performance, informing their expectations about the future. This over-extrapolation, which is also called the recency bias in behavioral finance literature, fails to fully consider mean reversion, the economic principle that high returns attract competition, driving future returns down over time. In the long run, stock prices follow business fundamentals, including growth, margins, and return on invested capital. In the short term, however, stock prices ebb and flow with changing investor expectations about the future, which is ultimately unknowable. These short-term price fluctuations create investment opportunities for patient, long investment horizon value investors who determine a stock's intrinsic value after a comprehensive, independent study of the historical business performance metrics of the investment candidate, its peers, its suppliers, and its customers. The value investor's deep dive into a company more fully considers the impact of mean reversion on business fundamentals. Unfortunately, value's outperformance is far from consistent. In fact, the 12-year period from the GFC through the COVID pandemic was value's longest underperforming period, causing many people to question the efficacy of value investing. This chart shows value rallies, periods where value outperformed by at least 10 percentage points. As you can see, the current value rally has lasted 21 months, 12 months shorter than the average value rally duration, with comparable cumulative outperformance. The current value rally began in October 2020 with the rollout of the COVID-19 vaccine, which dramatically changed investor expectations regarding the future. The COVID-19 lockdowns would end. Based on duration, the current value rally is 64% complete, which is meaningful but not necessarily compelling. But this analysis fails to consider the growth valuation premium, not only at the outset of the current value rally, but today. As detailed in the next couple of slides I'll go through, elevated growth valuation premium at both the beginning of the value rally and today provides evidence that the value rally, today's value rally, could look more like the tech bubble burst rally that you see, kind of the other long one highlighted there, which lasted 84 months and delivered 177 percentage points of outperformance. In our opinion, the current value rally will last longer and provide more outperformance than the average because the compelling growth valuation premium at the outset of this cycle and where it is today. This slide, which is, can you guys, let's see. Okay, we're gonna have to do this one. There's lines on that slide. What it's designed to show is the growth valuation premium across 4 common valuation metrics using the MSCI growth and the MSCI value style indices. And let me see, we're gonna come down. The current value rally's growth premium starting point are consistent with those of the tech bubble rally. So on this chart here, if you were to look at it, you'd see on a price to trailing earnings basis, the premium of growth over value is about 100%, which is pretty consistent with what it was at the start of the tech telecom bubble burst rally. And then the second thing is that the distance, today it's at about 90. So you've basically gone from 100 to 90 today, and you still have 38 basis points, 48 basis points of valuation premia points to get back down to the median. And so the point that we're trying to make on this slide is no matter which metric that you use, all of these charts are very similar. And they show that the current value rally starting point is on par with the tech telecom bubble burst, and that there's still considerable vertical distance between where we are today and the median. Let's see how we do with the next one. This slide. Okay. This slide looks more closely at the valuation price to trailing earnings, that the growth valuation premium metric using price to trailing earnings. And what it's highlighting is the dispersion, the difference between the top and bottom growth premium valuation deciles over time. The top decile stocks are a proxy for high growth stocks, while the bottom decile stocks are proxies for deep value stocks. Note the similarities of the current valuation dispersion with that of the tech bubble burst rally, so back in 2000. Also note that the current growth valuation dispersion premium remains wide. It's currently in the 38th percentile relative to the 27-year data set. In our opinion, the current 38th percentile dispersion data point highlights that growth stocks remain richly valued relative to value stocks because of the persistently high investor expectations afforded to high growth stocks today relative to deep value stocks. The wide valuation dispersions add support to the assertion that the current value rally will continue and deliver more outperformance. Moving forward to the next slide, in the interest of time, and because I actually think this slide's a little out of order, I wish I would have done it differently as I was preparing for this, I'll touch on it briefly. European stocks trade at a material discount to US stocks and represent strong potential outperformance candidates going forward. So if the value rally is going to have legs on a global basis, Europe's going to have to be a driver of that. Europe obviously is undergoing a uniquely challenging political and economic period, the duration of outcome of which are unknowable at this time. While we're modestly overweight European stocks within our global value strategy, our exposures are centered on banks, defense, and telecom companies, and we have no utility exposure. So we're involved in European stocks, but given the uncertainty of, around the outcomes with the Russian war in Ukraine, it's really difficult to come in there and say, hey, let's buy an industrial company in Eastern Germany. Next slide. This slide, make sure we got everything there. This slide highlights the growth stock valuation premium during the COVID-19 pandemic period. And again, it's using the trailing PE valuation metric in the MSCI World Value and Growth Indices. This slide shows growth valuation premiums over the past 27 years, the black line going up and down. And it highlights 3 data points. The pre-COVID level, which was in the 15th percentile. December 31st, 2020, which was in the 1st percentile. And currently, it's in the 9th percentile. These 3 categories all fall in the lowest quintile of observations. One way to think about it is value is more attractive today relative to growth than it was at the outset of the COVID-19 pandemic. And today, the valuation data point, the most recent one, the June 30th one, remains within the same valuation quintile as the start of the tech bubble burst rally. And historically, low quintile growth stock premium valuation observations have resulted in value outperformance over the ensuing, in this chart we show it over the ensuing 36 months. So when you're in that quintile, which we clearly are today, history says you're poised for value to continue to outperform over the next 36 months. Take a look at the next one. This one, I think next I'd like to turn to where we're finding investment opportunities within the value universe. But before I get into that, I think some color on the current economic environment will help set the stage. This slide highlights the historic inflation and interest rates in the United States. Inflation today is running at 4-year highs, while both short and long-term interest rates have increased dramatically since the Federal Reserve pivoted to a hawkish monetary policy in January of this year in response to high inflation. Interest rates are reverting upward toward their historic levels in response to the curtailment of unprecedented monetary policy stimulus over the past 12 plus years, which coincides with value's longest underperformance period. The next slide shows in inflationary markets, energy and material sectors have historically outperformed as their revenues grow in line with inflation while their operating costs remain relatively fixed. These cyclical sectors provide an inflation hedge, if you will, relative to the broader market. Conversely, non-cyclical market sectors, including consumer staples, healthcare, utilities, and telecom, have historically underperformed during inflation periods because their ability to pass through inflation is less robust, while their cost structures are more input and labor cost intensive. Value benchmarks have higher exposure to these cyclical sectors, which should provide a tailwind for us going forward. In addition to the cyclical exposure tailwind, value's lower valuation level becomes more important in rising interest rate environments. Lower valuation multiples are shorter duration cash flow streams, which are less interest rate sensitive than higher valuation multiple cash flow streams. Rising interest rates have historically been a tailwind for value investors. In our opinion, banks provide the most interesting investment opportunity in the current rising inflation interest rate environment. We think banks are particularly attractive for 3 reasons. First, compelling valuation discounts relative to both the MSCI World and World Value Indices. A critical tenet in value investing is price matters, and banks have a provocative valuation starting point. Second, banks benefit from rising interest rates because higher rates enable net interest margins to expand as lending rates rise more rapidly than rates paid to depositors, which, by the way, are currently close to their floor level at 0. And then third, banks have significant excess capital, even taking into account the increased regulatory capital requirements in the wake of the GFC. This excess capital is currently being aggressively returned to shareholders. Should the global economy sink into recession, clearly a risk in this current environment, the excess capital can be redirected to fund credit losses. So the balance sheets are built for a recession that may happen. If it doesn't or the recession is shallow, you'd continue to see excess capital return to shareholders. And why don't we do this? Well, you know what? Let's do this. We'll go, I'll catch up. This next slide, I'd like to use Goldman Sachs as an example to reinforce my earlier assertion that value investors focus on long-term business fundamentals to take advantage of short-term pricing fluctuations. So our firm's detailed independent industry and company analysis ultimately centers around one estimate: normal earnings. We define normal earnings as the sustainable level of cash earnings a company can generate under equilibrium economic and competitive market conditions. The left-hand chart shows Goldman Sachs' historic asset, loan, and deposit growth over the past 7 years, with the first data point indexed to 100 for comparability. Note the consistent positive growth across each metric. The right-hand chart compares stock price movements on the left-hand axis and our Goldman Sachs normal earnings estimate on the right axis over the same time period. Observe the comparability of the changes in the three growth metrics on the left chart with the progression of our normal earnings estimate on the right chart. Normal earnings track long-term fundamental business drivers. That's the whole idea behind them. Now, if you compare the volatile stock price movements with our relatively stable changes in normal earnings, value investors take a long-term view of a company's business prospects, informing their normal earnings expectations, and seek to take advantage of stock price fluctuations caused by the broader market's focus on recent data points informing expectations about the future. Also notice the current wide disparity between our most recent normal earnings estimate, about $35, and the current share price, which I think is about $280 on the chart. The greater the disparity between the current share price and the normal earnings, the more attractive the investment opportunity becomes for value. So the greater this delta, the lower the normal earnings and the more attractive it is. And what we're trying to do is, here's Mr. Market in the short term going up and down based on fear and greed. And here is the output of our research process, tracking the growth in earnings, normal earnings over time. And so we're guided by normal earnings in a market that's guided much more by the next data point. Okay, let me see here. Energy has been the best performing sector in the current value rally, outperforming the MSCI World Index by 80 points over the last year and a half. Notwithstanding the strong relative investment performance, energy stocks continue to trade at large discounts to both the MSCI value and overall world index. Above normal oil prices coupled with below normal drilling activity has produced significant free cash flow, which has been used to pay down debt and return capital to shareholders through dividends and share repurchases. We think energy companies represent a compelling investment opportunity for three reasons. First, favorable oil supply-demand dynamics should keep oil prices elevated even in the recession scenario. Second, disincentives to accelerate drilling encourages managements to continue returning free cash flow to shareholders. And third, energy stocks should act as an inflationary and geopolitical tension hedge in the current environment. The last area I wanted to look at from a valuation standpoint is software. Software companies trade at attractive valuation multiples relative to traditional recession-resistant sectors like staples and utilities, while offering higher growth rates and better balance sheets. We think software companies represent a compelling investment opportunity in the current environment for three reasons. First, they have stable, high free cash flow generating business models. Second, they offer higher growth rates versus staples and utilities, traditional safe havens in a recessionary environment, at better valuations. And third, software companies have a low commodity and labor cost inflation sensitivity. In effect, we're owning software companies in our clients' portfolios as a proxy for the defensiveness investors historically got from consumer staples. And then let me just see. The last slide here, this one's, well, at least we can see all the lines, that's good. But it's a little bit busy, but let me try to boil it down for you. Our global portfolios are overweight banks, energy, and software companies. This slide shows our global value strategies trailing and normal price to earnings ratios over the past 8 years and compares them with the MSCI value and growth benchmark. Note, the growth premium multiple remains wide and our portfolio trades at lower multiples than the MSCI World and Value indices, both on a trailing and normal earnings basis. Disciplined value investors focus on companies trading at valuation discounts relative to the broader market because we believe price paid is a critical determinant of investment return. And then I would also note here is going back to consistency, in a world where the indexes are up and down and all, these are market cap weighted, our normal earnings, price to normal earnings multiple has remained relatively constant over the 8-year period. That's, in our opinion, that is us consistently doing our job of determining normal earnings and being conscientious about the multiple we're paying for normal earnings. And then just to wrap up on a summary slide, the last slide provides a summary of the key points I tried to make during this presentation. First, value is attractively priced relative to growth, despite the current rally. Second, I don't know if I did that or not, but we got this. We expect the current value rally to continue because of the provocative growth valuation premium remains wide today. And third, market volatility creates investment opportunity for active value and also growth managers. Thank you very much for your attention, and I look forward to answering your questions.
A world of investment opportunity awaits. There are specialist sectors and regions well positioned to benefit from growth drivers such as aging demographics, innovation, urbanization, and growing consumerism, and a greater quantum of companies in which to invest and diversify. There are also thousands of fund managers looking to take advantage of these opportunities to generate long-term value for their clients. But how do you decide which of these fund managers to choose? The answer is simple. Let Momentum Global Investment Management do the fund selection for you. Presenting the Momentum Global Equity Fund, our flagship global equity fund, which provides exposure to global developed market equities and aims to deliver long-term capital growth in a highly liquid, cost-effective structure. With a strong track record going back to 2009, our Momentum Global Equity Fund has been designed to capture the very best investment talent from around the world, including Robeco, Jennison, Rainier, and Hotchkiss & Wiley. Be it high conviction, active strategies, or data-driven systematic strategies, the fund combines human intellect with data science, incorporating carefully selected equity managers for their specific investment style approach and strategy, impressive long-term track records, robust processes, and competitive edge. So what does this mean to you? This approach has several advantages, including lower underlying management fees, a blend of quality, growth, and value investment styles, diversification across different geographies, sectors, currencies, and companies, and access to specialist global fund managers that you may otherwise not have access to. Through the Momentum Global Equity Fund, you get true global and multi-layered diversification. By providing access to specialist global investment managers, the Momentum Global Equity Fund has made investing in offshore equity that much simpler. Speak to your Momentum Investments consultant today. With us, investing is personal.
Think Tank is an event designed exclusively for investment professionals and institutional investors. It is a true collaboration of investment specialists providing independent, non-conflicted views and opinions, achieved by avoiding sponsorship and other financial promotions, and with the aim of sharing knowledge and ideas, giving Think Tank an excellent reputation within the investment industry. Originally designed to provide our South African clients with a global, independent perspective on investment matters, Think Tank has gone from strength to strength, and delegates now attend from all over the world, making Think Tank a truly global event. The combination of independent thinking, thought leadership, idea generation, and depth of analysis supports delegates in their quest to achieve their own clients' goals. The first conference was held in 2002 in the heart of the City of London, the world's leading financial centre, and has been held there for the last 20 years, with the exceptions of 2007, when we chose New York, and 2010, when we ventured to Hong Kong. In pandemic-ravaged 2020, we held our first virtual conference, which was a huge success with over 1,000 delegates online. Think Tank aims to cover topical events in the global economy and financial markets, with a particular theme each year based around the most important issues facing investors, as well as exploring longer-term perspectives on investment opportunities globally. Each year, we invite a range of outstanding and experienced speakers from around the world, including strategists, economists, investment managers and analysts from global investment banks and specialist asset management firms. We carefully select the topic for each speaker to make sure we offer an unrivaled variety and depth of analysis and strategic thinking. Book your seat for Think Tank in the heart of the City of London.
Good morning, everyone, and a very warm welcome to Think Tank 2022. We're proud to have built and maintained such a strong following and reputation for this conference over the years, demonstrated by some clients having attended almost every one. We look forward to celebrating these milestones with you this evening at the very special dinner venue of St Paul's Cathedral.
This is a truly remarkable time. I mean, we have gone through one crisis after another. Trying to pin down forecasts and an outlook is incredibly difficult.
And there's great opportunity right now. And I'll say for growth stocks in particular, Europe is cheap. It's actually has some really good ones that are pretty attractively valued.
It's been a particularly interesting year for alternative investing, and it's been quite a strong year for the portfolio.
Portfolios that we are building for the next 10 years will probably have to be very different from the way we built portfolios over the last 40 years.
I guess I'd sum up my highlights in three key things. Firstly, just the quality and the breadth of the speakers over the course of the last couple of days. Some of the new thinking and new ideas that came from those presentations.
I think one of the highlights was just to mingle again with fellows from abroad and also to get insights from outside South Africa in terms of world economy, what we can expect going forward, and also the challenges that we see in Europe as well as the US in the future.
Definitely hearing from advisors all over the world about the challenges facing their clients.
You have to be extremely picky, extremely fussy in whom you choose to back, and if you actually do, back good quality people, good quality entrepreneurs, then the investment success comes with it.
I must say, away from the conference, our function at St Paul's last night was amazing, but then the content generally was pretty good, and I really learned a lot and have so much to take back to my investors.
St Paul's Cathedral tour was super special. Having dinner in an ancient building and experiencing an atmosphere was definitely a highlight, and I will remember that for quite some time.
Good morning, everyone, and a very warm welcome to Think Tank 2022. We're proud to have built and maintained such a strong following and reputation for this conference over the years, demonstrated by some clients having attended almost every one. We look forward to celebrating these milestones with you this evening at the very special dinner venue of St Paul's Cathedral.
This is a truly remarkable time. I mean, we have gone through one crisis after another. Trying to pin down forecasts and an outlook is incredibly difficult.
And there's great opportunity right now. And I'll say for growth stocks in particular, Europe is cheap. It's actually has some really good ones that are pretty attractively valued.
It's been a particularly interesting year for alternative investing, and it's been quite a strong year for the portfolio.
Portfolios that we are building for the next 10 years will probably have to be very different from the way we built portfolios over the last 40 years.
I guess I'd sum up my highlights in three key things. Firstly, just the quality and the breadth of the speakers over the course of the last couple of days. Some of the new thinking and new ideas that came from those presentations.
I think one of the highlights was just to mingle again with fellows from abroad and also to get insights from outside South Africa in terms of world economy, what we can expect going forward.
We've got a real treat for you next in the form of Mark Barabo, our next speaker. So for many of you, Mark needs no introduction. He's a regular speaker here at Think Tank, and our relationship with Jennison has been one of our longest and most successful. So without further ado, take it away, Mark.
Okay, well, we're going to kind of move our presentation into three quick parts. I'm going to talk quickly about just a broad market overview because it's been a really negative environment for growth stocks, which is what we do for your portfolio. But that's sort of turned the corner by the end of May, and we think we're back on a solid path, and we'll talk about reasons why. And then some of the structural areas of the market we really like going forward. And instead of making it very broad-based, I'm just going to focus on a few because I think it's more interesting and I think they're going to have a big impact, more importantly. And then we'll just review the portfolio quickly so you can get a flavor for where we're invested, how we've performed, unfortunately, in the last year. You notice that's page 26, so I'm trying to bury that. But I'll cover it, don't worry. So quick market overview, you know, growth stocks really tumbled over the year to date. It actually started at the end of November last year. So if you look at the blue bars on this page, this is since 1997. We kind of break the market into quintiles of growth. And typically that top quintile, then the second quintile, which is more like stable growers. They're still double-digit growers, but more stable, like an LVMH, that kind of name. Maybe a drug company. Those top two quintiles really perform exceptionally well over time. And in fact, when you decompose market returns, they account for most of the market's absolute return over time. So it's really important to focus there, we think, and that's why we love that area as a shopping ground. But you can see over the last year-to-date period, the green, everything flipped on its head. The slow growers, that bottom decile, performed the best. The faster the growth, the worse it performed, obviously because of valuation. So we'll talk about that in a minute. But these types of patterns don't last for long. You're going to revert back to fundamentals, and the market's going to come back to names that are really putting up outstanding numbers, particularly in a troubled environment. So anyway, we kind of got flipped upside down this year, but our history shows that doesn't tend to last very long. One of the things that's going to happen to the market this year and next year is earnings growth is going to dramatically slow. Obviously, coming off that post-pandemic V-shaped recovery around the world, you had a surge in earnings growth. We all know what's going on in the markets today. You have monetary policy tightening cycles around the world outside of China. Maybe Brazil is at the peak of their tightening cycle, which is good news there. But inflation pressures and other things have really crimped earnings growth so far this year. So we're in for a more normalized period of earnings growth in the market. That's going to tend to benefit growth stocks. Growth multiples have been hammered this year. So you can see growth relative to value, and we're using the S&P 500 because the US market tends to be dominated by growth companies, so it's a good measure, but this happened around the world, as you saw in that first chart. So it didn't really matter which market you were in. You were hit by the same compression and multiple. We're down way below long-term historical averages on growth relative to value, so that drop by a third in multiples has really been felt considerably. We certainly took out the COVID premium. So why did growth stocks do so well in 2020 into 2021? Because those companies were sailing through the pandemic, putting up strong results because they're in technology, e-commerce, et cetera. They were able to deliver goods and services, whereas the rest of the market struggled. That premium is long gone. In fact, it's at a big discount to where the market was back in 2019 or 18. So we think the reset has happened. The other important thing to remember is growth stocks tend to do well during tightening cycles for the very reason you would think. As interest rates go up, the economy is going to slow, earnings growth is going to slow. Companies that have secular growth behind them tend to do better as companies, and they tend to do better as stocks. And you can see that in the blue bar versus the green bar, which is value. And again, the reason we think we've worked our way through most of this is your portfolio and growth stocks in general have performed well since the end of May. So that giant reset, we think, is largely behind us for these reasons. So what are the areas that we're focused on? I'm going to talk about three major regions. You know, we don't do regional investing. We do bottoms up. But, you know, if you decompose the portfolios, these are the three big areas we're in. But we're not diversified within those areas. They're highly concentrated in a few pockets. So number one, in the US, you know, not surprisingly, it's technology-centric in terms of our positioning. That's where the valuation reset was the worst. But we think also that's where the opportunity now is getting better. And our exposure in that part of the market is starting to go back up, which is a good thing, I think, looking forward. In Europe, most of our exposure is in luxury. It's in consumer companies that have a direct-to-consumer model in most of their markets. It's either through their e-commerce engine or through their boutique stores. So they control their inventory, they control the customer engagement, and their consumers are less impacted by economic woes. But most importantly, their supply chains are immune to problems because most of it's made locally. And there's a reason these companies aren't missing numbers and having problems in this market environment. It's because things are running very smoothly from them from an operational perspective, and demand trends are very robust. We can talk about why, but it has to do with younger consumers just on a cultural basis moving to luxury. The majority of sales for Louis Vuitton or Hermes or Chanel, it doesn't matter, Dior, the majority of sales are to people or millennials or Gen Z. Around the world. It's not just in the US or China, but around the world. So it's not old people like me. It's the young crowd really likes the products. But most importantly, the business models are built to succeed in this type of environment that's randomly been thrown at them. That's why the execution is robust as well as management foresight. And then in emerging markets, usually again, in a tightening cycle, it can be rough going because currencies can come under a lot of pressure vis-a-vis the dollar, which has happened. There's a lot of instability in the markets. But our focus is on innovative companies in emerging markets. It's not on slow growth companies. And we think they stand a chance of really performing well from here, particularly in big areas like fintech, financial technology, where you're seeing a massive structural shift based on disruption, moving away from traditional financial services companies, which have underserved those markets, into technology platforms, which are seizing that opportunity at lower fee and easier access. That's all because of the development of the mobile internet and the smartphone. That's what's enabling that migration. Okay, in technology, the biggest trend today is the move to cloud-based computing. This is not new, but it's actually not slowing down. Despite all the turbulence this year, the big cloud providers like Amazon's AWS, Microsoft Azure, Google Cloud are all showing robust growth rates, in some cases acceleration, and they're already growing at 30 to 40% a year. And these are big, I mean, it's hundreds of billions of dollars of money that's moving from on-premise enterprise computing to the cloud, so it's cheaper, easier to maintain, and the security is better. And so this migration, we think, has years to go, but so far this year, it's been very robust. So it's one of the areas we're heavily positioned in, because again, that's where the money is flowing. That's where the capital spending is going. That's where businesses are prioritizing their IT spending budgets. So we like it. The negative about it is it's enterprise. It's not consumer, which we prefer usually, like an Apple, because consumers are, you know, there's millions and millions of us spending money. That's a better market than a CFO saying yay or nay to, you know, a $20 million project. So we prefer the consumer side of technology, but we can't fight this trend. The enterprise side is where most of the new money is flowing. The other area of applied technology that's booming is digital payments. We've talked about this in the past, but it's really booming this year as well as last. And you can see it's a consistent double-digit grower. That's the total bar chart here. These are transactions that are occurring on a purely digital basis, either through e-commerce or now increasingly point of sale. And that gray part is the fastest growing part, and that's point of sale. That can be from you using your phone instead of an Oyster card to get on the subway or to pay for anything on a contactless basis. It's booming around the world. And to put, you know, some flesh on it, one of the biggest winners from this is Adyen. It's a Netherlands-based company. They built their company from scratch to be digitally native, so they're not going through a transition or doing acquisitions, bolting on multiple forms of technology that are hard to put together. This is a pure scalable model, and they're winning in the global marketplace. They're growing their sales about 60% a year, and a big part of that growth lately has been unified commerce. What does unified commerce mean? That's if you're a Nike, or if you're a McDonald's, or if you're an H&M, which are customers of theirs. It doesn't matter if you and I buy something online, order it online, pick it up in the store, have it delivered. It all happens on a unified payments platform where they can identify us, the customer, and they can seamlessly track that purchase securely, without fraud, and with better acceptance rates, so that you, the customer, don't get turned down artificially. And they're winning with this unified commerce platform, and companies that don't have this are going to lose big in the marketplace. So that's why they're winning so much market share. If you look at where penetration of digital payments is the biggest, you know, you can see here, you got some big mature markets like the US, 89%, the UK, 89%, China's at 88%. But Adyen is winning in the developed markets in a very mature market by having a best-in-class solution. So they're gaining a ton of market share. So that's one way to win. The problem is there's only one Adyen. There's not two or three. And so the bigger shopping area for us, or the bigger pot of gold, is in the rest of the market, where you have low penetration, particularly in emerging markets, ex-China. China's very sophisticated in digital payments. It's owned by Alibaba and Tencent, but the rest of the world's wide open, and that's where we see great opportunity. The other thing that's happening is not just digital transactions in emerging markets, but access to traditional financial products like credit. Huge opportunity in markets like Mexico, Brazil, Argentina, and we're heavily invested in this area because using digital technologies or platforms, you don't build out a banking system or a banking network with branches. You offer it on a mobile phone, and all of your banking is done on a digital device. And it's far more, it's growing far more aggressively than traditional services. The opportunities are also big in Southeast Asia, depending on the market. Some are highly penetrated, like Thailand. Other much bigger markets like Indonesia, very low penetration. Nubank is one of the examples of a company we're investing in, which is one of these new breed of fintech companies that's providing credit in Latin America and growing rapidly. Here you can see their user growth. It took years for adoption to gradually grow, and then it hit that S-curve, what we call that S-curve of adoption, where it becomes viral. And today they have over 60 million users in Latin America. It is the largest digital bank in the world, and it will become even bigger in Latin America over the next several years because they're attacking big markets now like Mexico, which is going to be a great opportunity for them. So these are some examples of where in emerging markets you're seeing access, financial inclusion, really driving entrepreneurs' a vision about how they can penetrate that market and take it from a system that just doesn't really serve those customers or serves them at very high price. So this disruption is a really important one of our favorite areas. Okay, let's move to the big one though, that's going to move hundreds of billions of dollars of market cap over the next 5 to 10 years, and that's electric vehicles. You can see penetration rates by the end of 2021 are pretty low in most markets. We use Norway as our golden child of where the world is moving. Norway leads, what can we say? Electric vehicles, in China by the 2021 were about 13% of the market, in the US less than 5%. Europe's a little bit stronger than that. The big markets like Netherlands or Germany have higher penetration, but they're still way below 20%. But what's going to happen is this. So you saw in the previous chart that Norway was, over 50, but actually in the first half of the year, it's now almost, it's broached 70%. It's approaching 80. This is one of the interesting things about disruptive products. It usually takes 18 to 20 years, or 15 to 20 years, to reach 80% penetration. So when the Model T was invented, it only took 18 years for the US to have 80% penetration of vehicles. That's a lot of horses that put out to pasture, so to speak. But it only took that short period of time. For television, the same thing. Radio, the same thing. Telephony took longer. It was a bigger CapEx spend. But wireless, of course, was much faster because you already knew the use case. So for electric vehicles, we would expect, if Norway hit it in year 12, we would expect the rest of the world to follow pretty quickly. And so by 2030 to 2035, somewhere in that time period, 80% of all vehicle sales in the world will be electric. That's important for profitability because electric vehicles are dramatically more profitable than combustion engine. And if you look at Tesla on the right side, their free cash flow per vehicle in 2021 was almost $4,500 per unit, dramatically higher than BMW in the luxury end of the market, and of course, hugely more profitable than mass market. So, you know, EVs just have a structurally better profit component to them. That's why Tesla generates more profits than anyone else. And part of it is the business model's better, other than the components cost less. So the old model, you have dealers, you have repair shops, you have gas stations, you have an insurance company. With the new pure EV model, first of all, you have software, which is more valuable than any of that other stuff. Tesla's just started an insurance business because it can track your driving every second, which they do. And they know if you're a good driver or not, and they can offer you insurance at a better rate. They're not guessing, they actually have your data. The charging platform, they can charge for that. So there's no gas station. You go pull up into a Tesla supercharger. The repairs, the company does, but there are very few repairs in an electric vehicle. Maintenance is close to zero. So in fact, it's not a big dollar thing, but for you as a consumer, it's a huge cost saving. And then the vehicle purchase is done online. You only buy Tesla online, you don't go through a dealer. So they keep that 6% margin for themselves. So what you're witnessing is this huge transformation, not just of the industry, because consumers want electric, it's better. It's better performance, it's cheaper to operate, and it's cheaper to maintain. And it's green, at least in their view. Who knows where the electricity is generated. But it's compelling for the vehicle manufacturer if you have the right model. Okay, in the US so far this first half of this year, obviously it's winner take all here. Tesla dominates the market, including, that's the Model Y and the Model 3. And then here's the Tesla Model S and X. So, you know, that's over 250,000 vehicles. Obviously the next competitor is at 20. So it's not even close. In Europe, they also dominate, but they have more competition. Because Europe doesn't demand as high range vehicles, they're lower range, not as efficient, they don't, you know, per mile or kilowatt or kilometer driven, they're not as good, but it doesn't matter because you don't need the range. So there's more competition in Europe, but Tesla still dominates, and their dominance is going to grow over the next year because of their Berlin factory. And then in China, they also dominate, and most importantly, because it's at the high end. They do have BYD as a competitor, and if you add up all of BYD's models on this chart, which there are many, there's one there, they actually are bigger than Tesla in the first half of the year, just slightly. We expect that to continue, but they're mass market, and Tesla's profitability is double that of BYD's. So again, most of the profits are going to be earned in the premium end of the market. So the transformation of the industry is being driven by the disruptor, the company coming from nowhere and redefining what the auto industry model should look like and redefining the consumer experience. This is a classic disruption like we saw in personal computing, like we saw in the smartphone. It's nothing different than that. And so the playbook is pretty clear to us. You play the leader, the disruptor, until the market is saturated. And so there's a long window of growth here, and we think it's quite compelling. And this is going to be the single biggest industry transformation or disruption in the marketplace for the next decade. I'm going to skip healthcare for the moment, just in time, because I want to leave time for Q&A. I told you I would get to this page, unfortunately. So, trailing 1 year, and I believe this is as of the end of July. No, it's the end of June. You know, down 35%, way below the market return, which is 15.8. So that was quite a bear market for growth stocks. You know, on a 3, 5, 7, 10-year since inception with momentum, the numbers look very strong, but that was quite a hit. Something we haven't seen since, really since 2001. Very outstanding negative result there. When you look at the winners over the last year, it's pretty slim pickings here. So that's on the left side of the page. You know, Tesla's number one. Then you have Novo Nordisk and Eli Lilly in treatment of diabetes and obesity. Those are going to be big market opportunities for both companies for the next few years. They both have new products coming to market, which are going to be, we think, significant, multi-billion-dollar opportunities. So we like both of those companies. You see some technology companies like NVIDIA or Apple. And then, you know, biotech like argenx. Ferrari, you know, the lone luxury winner over the last 12 months there. Importantly, where there's a dashes, those are stocks we didn't own. So 7 of our top 15 winners last year were things we didn't own. That's not saying much, that were catastrophes in the market. And then where the damage was on the right side was really in either emerging markets or developed market e-commerce related technology platforms or e-commerce companies, such as C Limited or Mercado Libre, Shopify. It was in other technology enablers like Airbnb or Roblox, etc. It was really in the, I would call it more in the emerging growth category. So the more aggressive part of the portfolio was hit the hardest. Now of this list, 7 of the 15 are still in the portfolio because we don't, while they perform poorly, we don't think there's anything wrong with the business. In fact, they've beaten numbers consistently. It's just the valuation got marked down. But since their fundamentals are pretty robust, we're going to ride through the rest of this storm with them. We think that's really the prudent thing to do. The others were sold just because the business benefited too much from the pandemic and it was not sustainable. It really couldn't have the legs to grow off of that base. I mean, it might take a few years to absorb all of that pull forward of demand. So that's kind of the nutshell in terms of the winners and losers. Not a pretty picture over the last year. In terms of where we've been active, by sector, I guess there's only one major thing going on here. So if you look at the far left, you can see communication services coming down in weight over 4 quarters, and in the middle, healthcare coming up and kind of absorbing it. That's the only major shift in the portfolio. The communication services really is internet, and so it happened in 2 phases. The first phase was we exited China very aggressively beginning last January, I mean a year ago January, and there was very little left in the portfolio over the last 4 quarters. So that big drawdown, which was important because in 2021 China did implode on the internet side, and we actually added 100 basis points of excess return last year in China. So it was really important we made that move. The rest is just taking profits in some of the big ad spending platforms which benefited, which we've now just reduced in size. Nothing dramatic. And in healthcare, just taking it up because you do have some product cycles that are interesting coming in biotech and pharma, which we want to take advantage of. And then we have the tools companies that are enabling these innovations to really flourish. And so demand is quite strong there. It's also not cyclical. It's not impacted by interest rates. It's not impacted by inflation. It's not impacted by the economy. So we figure it's a pretty good place to be for a while because the economies are going to slow and we need some protection in there. Other than that, not much is going on. You can see tech weight starting to come back up. We're just taking advantage of those depressed valuations we saw in May. And you know, but you can see historically we're probably not going to go a lot higher than that weight, but there's always going to be opportunities to maneuver there. By region, I guess the only interesting thing I would say is emerging markets is single digit, 8-9%. The last few quarters, that's kind of a bare minimum for us. We're just kind of sitting there in those fintech dynamos that I highlighted. We really like them, but EM's still pretty dicey right now. But you know, for those companies, it's okay, and the valuations look really good. So we're hanging out, but at a very low exposure for us on a historical basis. China's, you know, very low in terms of exposure because it's China, and we're not in the internet at all. We're just in some healthcare and BYD and electric vehicles. We think the internet's over for China in terms of investability because of the government. And then Europe at 44, trust me, we're not bulls on Europe. It's just, these are global companies that happen to be headquartered here. They're doing really well. We're there. We're bottoms up oriented. We're not regional. But I get that question a lot. Why do you love Europe? We don't. But we love some companies in here a lot. And there's great opportunity right now. And I'll say for growth stocks in particular, Europe is cheap. It usually isn't. But for growth companies, it's actually has some really good ones that are pretty attractively valued right now. These are our top 10. I'd be happy, and I'll end the presentation there and open it up to Q&A, and hopefully we have a pretty good dialogue.
Hello everyone. I hope you have enough batteries for the next speaker. It's going to be the last one in the morning, then I promise you'll get lunch to get them recharged. So my name is Lorenzo Laposta. I have the pleasure of introducing you to Fred Ingham, Head of Hedge Fund Investments at Neuberger Berman and Portfolio Manager of the Uncorrelated Strategies Fund, which we hold widely across our multi-asset portfolios. In a year like this, where traditional multi-assets have been struggling a bit and equities and bonds down, it's been great to have some diversified return streams in our portfolios. But I'll let you, Fred, describe how the magic is done. So please welcome Fred Ingham.
Thanks, Lorenzo. Hi, everybody. I know that I'm all that stands between you and lunch, so I'll try to keep this to the point. I was quite excited, actually, a couple of months ago when my colleague in sales told me that I'd been invited to the Momentum event in London in early September because I could never get tickets to the test match. But it turned out it was the conference, and I'm really glad to be here because it's been a particularly interesting year for alternative investing, and it's been quite a strong year for the portfolio. And there's a lot of interest in the space right now, and I think never has it been more relevant. So what I'm going to do is I'm going to touch briefly on why alternatives are of interest to investors today, much of which should be fairly obvious. I'll talk a little bit about some of the potential pitfalls in the area, some of the things that potentially should be avoided in the current kind of environment. I'll go on and talk about some of the things that have worked, some of the areas of opportunity, and I'll finish off touching briefly on how you might put that together. So, current environment. I mean, most of my career in the last 20 years I've spent analyzing and investing in alternative strategies, but unfortunately for me, most of that period has been the best performance in history for 60-40 portfolios, characterized by persistently rising asset prices driven by liquidity injection from central banks. If you look to for the period from April 2009 through to the end of last year, the S&P appreciated 490%. It was a pretty persistent bull run for fixed income. A 60-40 portfolio was a pretty reliable place to be. But that isn't clearly always the case. It hasn't been the case this year with the worst first half for 60-40 that we've seen historically. And even if you look back at the decade preceding April 2009, you'd see for 10 years, the S&P down close to 30%. you could note that the CAC index in France is below its peak of 2000 today, and the Nikkei still hasn't recovered its 1989 peak. So equities don't always have to go up, and nor do bond prices, and nor does there have to be a negative correlation between the two. And I think the problem for many investors today is that the reality of stubborn inflation is pushing bond prices up and equity prices down. And so the defensive characteristics of bonds in an equity bond portfolio has lost its utility. And that's the factor really that has pushed people towards investigating alternative solutions and trying to work out why diversifiers that might have been less interesting when equities were appreciating at 10% annualized rates are much more relevant today. And I think people are more willing to accept that a relatively conservative, positive, absolute return over a cycle that generates its income or trading gains from sources that are orthogonal to the broader market is of increasing value and very relevant today. So if you are going to allocate to alternative space, where should you allocate? I focus on the liquid alternatives categories, and you see 9 of the most popular liquid alternatives categories outlined here on the slide. And what I've done is I've looked at the correlation of 20 years of returns of the indices for each of these sub-strategies to the MSCI World. So in a way, it's a proxy for looking at their diversification potential over time. On the left-hand side, you see many popular hedge fund strategies. Equity long-short is the first, event-driven is the second. These are the areas that you'll see plenty of investment in alternatives because these have worked best over the last 10, 20 years, not as diversifiers, but as sources of absolute return. Why is that? It's because they have a beta component to their trailing returns. They tend to be long biased towards the market. They tend to do well when markets go up. Unsurprisingly, those are the strategies that have really suffered this year, equity long-short in particular. And some of what we've heard discussed earlier today, some of the sell-off in growth, some of the difficulties in stock picking for this year have really impacted that side of the chart. Fortunately, our area of focus is on uncorrelated strategies. And so we primarily invest on the right-hand side here. And these are strategies that for 20 years have displayed little to no correlation to the equity market. They're not always the most attractive places to invest. Their Sharpe ratios aren't always the highest. But we believe that there are interesting and relevant trades in these sub-strategies today. And if you can combine them in an appropriate manner, they can create an all-weather profile that will benefit you through a cycle. So I'm going to talk a little bit about some of the areas that we've seen working this year, and some of the areas of opportunity. And volatility relative value, or in ordinary parlance, options trading, is clearly a space that has been of interest this year and where we've seen some reasonable levels of returns. On the bottom right-hand side here, I've shown the index performance of the HFRI Volatility Relative Value Index against MSCI World and Barclays Global Ag. Not that impressive, a 4% return for the year, obviously good to be positive, but you might have expected volatility strategies to do better. The reality is there's been a very wide differential between strategies within vol that have worked this year and strategies within vol that have not. And I think a number of people are quite disappointed with potential tail protection that they had on because equity volatility hasn't necessarily performed this year. Top right-hand side, we chart the VIX, and you can see the VIX, while it has been a bit higher this year than 2021, hasn't actually really peaked, certainly to the extent that you might expect it to have done, given the depreciation in equities that we've seen this year. And why is that? Well, I think a lot of investors came into 2022 already somewhat nervous about equities. Institutional buyers in particular were hedging portfolios with put options. And so as the market started to fall, people were monetizing option hedges, which kept a lid on implied volatility and stopped the kind of pop that you might have expected in equity vol. There has actually been more action in fixed income volatility and currency volatility this year, where you've gone from a low base to a much higher base. But the change this year that has been relevant and profitable is on the bottom left. So one of the measures we look at for whether volatility strategies might perform is there a follow-through? So if the market falls on a given day, is it likely to fall the next day? If it plunges in a week, is it likely to plunge the next week? And over the long term, what you tend to find is that a falling market generates a further falling market. So if you've got an option bond and the delta starts to expand, it starts to make money, the market falls further, you make more money. 2021, you can see, was the opposite of that. We all know it was a very mean reversionary market. Every time equities sold off, they found a bid, had a bounce. 2022, completely different scenario. When equities have fallen, they've typically fallen again. And so we think that means it's an environment where being long vol can potentially reward you because you've got this floor that's been removed from the market. The Fed put's gone away. Markets don't really have any reference point or anchor of value driven by protection from central banks. Investors themselves are less protected, having monetized some of those puts in their portfolio. And so that's a potentially good environment for volatility trading strategies. What in particular has worked? Well, one area I'd highlight that's worked well in our portfolio this year that's been a major source of gains is dispersion. What is dispersion? Well, effectively, dispersion is buying volatility or buying options on single stocks and hedging that by selling options on indices that those single stocks sit on. Why might you want to do that? Well, index options are typically overpriced. Index options are regularly purchased by long-only asset managers and buyers, pension funds in order to protect their portfolio. They're not necessarily particularly price sensitive. They just want to buy a 5% out of the money, a 10% out of the money put so that they know they've got some crash protection. On the single stock side, you've got much more balanced buy-demand dynamics. And in fact, single stock volatility or single stock options can trade cheap. That's because banks sell structured products around single stocks to retail investors and in some cases to institutional investors. They then generate volatility that they need to hedge themselves on, and hedge funds can take the other side of that. So effectively, index options tend to be rich and single stock options tend to be, if anything, cheap. So buying single stock options, hedging with index gives you a potential return. You can then use some of that value cushion in order to buy yourself further protection. So you can buy more volatility to give yourself the ability to make money if volatility rises, as well as arbitraging the two characteristics. And the interesting thing about that profile, and one of the reasons it's worked so well this year, is that the best case scenario is violent rotation within equities without violent moves at index level. Because if, for example, growth stocks are going down heavily, value stocks are going up heavily, the index itself has muted movement, but you've got a lot of movement on the individual stocks. And that's very much what we've seen this year. So if we look at the profile, a P&L payoff of dispersion, and this is a carve out of one of the allocations in our portfolio, you can see that you tend to get this characteristic where you're naturally long volatility. So should there be a crisis like the pandemic, you see March 2020, you see very steep returns. But if you have a period where there is a somewhat schizophrenic market and there's back and forth between value and growth, there's rotation across sectors, and single stocks are moving a lot more than index, again, you can generate strongly positive returns. And that's what we saw particularly in the first quarter of 2022 as investors adjusted their portfolios to respond to higher interest rates and discounted future earnings back much more steeply. But you also get an upward drift over time because of that premium that you're earning. This is a somewhat more complicated chart, but the point we're making here is effectively, with this trade, you really want to have low realized correlation between stocks. So you want stocks to be behaving differently to each other relative to the level of index volatility. And when we look at it in the US on the left, or in Europe on the right, the dark dots that you can see here are the recent period. What we've seen is that correlation has been quite low, so stocks have been behaving quite differently for the level of volatility of the index. And again, that's a win for the trade. Another commonly cited area of volatility trading that hasn't done well this year is convertible bond arbitrage. Now, we've had pretty small exposure to CBARB this year, so it hasn't really been a cost for us. But certainly the convertible bond space has had a very difficult year. So the first half of this year, the global convertible bond universe fell about 16.5%. It was the worst first half in the history of the convertible bonds, looking at the last 20 years of markets. And why is that? Well, long-only buyers have seen significant redemptions this year as options in convertibles have gone out of the money. Hedge funds that are big investors in the convert space have degrossed and seen risk reduction this year, as well as they've lost money through holding convertible bonds. And all of this has cheapened up convertible bonds relative to hedges. We've got two charts here. We look at the cheapness of global IG converts on the top right. So you can see some cheapness, but particularly in Europe. And on the bottom side, we've got the cheapness of European convertibles relative to theoretical prices. And you've got about 4 points cheapness today of European converts relative to where we think they should trade. So we think it's a good opportunity today to step in and take the other side of some of this selling. You hedge yourself by shorting the equity of the underlying stock. You hedge the credit, so you're not taking market directional risk. You can hedge your interest rate risk as well. Isolate the cheapness of the option and put yourself again in a long volatility position where if the underlying company falls steeply, you can realize a substantial gain. If it appreciates and rebounds, you can make a gain too. And if convertible bond prices normalize relative to equivalent credit, again, you put yourself in a good place. So converts is an area that hasn't worked for volatility strategies this year, but where we've actually been increasing exposure, and I wouldn't be surprised to see it being a source of return for us over the next 6 to 12 months, but it's a non-directional source of return. Another area that has been pretty successful for us this year is short-term trading. So again, I'm using index data here, but actually our returns on short-term trading in the live portfolio are pretty similar. So the index is up about 11.5% year to date, again, versus steep falls in equities and fixed income. What is short-term trading? Well, it's really systematic futures trading. In our case, across equity indices, FX, and interest rates and sovereign bonds. In some cases, you can trade commodities too. And really, you're looking for patterns over short time periods. It could be minutes, hours, days, or at the long end, weeks, that are repeatable in markets that are predictable in order to take both directional and relative value positions. And one of the characteristics of short-term trading, particularly in the way that we like to execute it and allocate to it, is short-term momentum models or volatility breakout models. And those models are usually looking at short-term price patterns of, it could be interest rates, it might be an equity market, looking at breakouts of ranges across different standard deviations. They'll combine those models with analysis of market volume, of market microstructure in some cases, to try to estimate, is a breakout real or false? And that tends to give you a long volatility characteristic to some extent, because if something starts to fall and it breaks through a key level, a short-term futures trader will typically get short. If it breaks out on the upside, they'll typically get long. And unsurprisingly, this year, particularly in the short-term interest rate space, we've seen a number of breaks, US 2-year particularly, US short-term futures, short-term interest rate futures as well. We've seen it in the UK too. And interest rate trading has been a pretty significant P&L generator for us this year, primarily on the short side. We also saw it in equity indices in June. So being short equities in June as the market fell and then fell again mid-month was also a P&L driver for us. And the characteristic of short-term trading is one where if you decompose returns into quadrants of market volatility historically, you'll find that on average, the strategy does better in more volatile market conditions than in less volatile market conditions. Now, if you look back over the last decade, most of the years in the last decade have been sub-average in terms of cross-asset class volatility. But I think we're now entering an environment where a contraction in liquidity that looks structural will mean that we're gravitating more towards, I'm not saying the world's going to be hugely volatile, but all it needs to do is move back towards kind of long-term volatility averages, not those compressed levels of post-QE. And I think that's where we are, and it's quite an interesting environment for these kind of strategies. Other areas that have worked quite well in short-term futures trading are actually cross-asset class models. So looking at the impact or the co-relationship between and across asset classes. So as interest rates have moved this year, there's often a lead lag effect on underlying currencies. Or as commodity prices have moved, there's a lead lag effect on underlying indices. And the more panicky those moves tend to be, the greater the inefficiencies and the greater the opportunity to make money. Conversely, there are also mean reversion opportunities. So some markets get stretched relative to others. If fixed income is selling off, but the Bund contract is more sticky, you might want to short the Bund and buy fixed income on the other side. So lots of different types of trades, lots of behavioral biases being exploited, a strategy that ultimately is uncorrelated to broader markets, uncorrelated to pretty much anything else, hasn't been very interesting for a lot of investors because it hasn't done much until this year, although it has been one of the best performing strategies for us over the last 5 years, but I think quite relevant to where we're going. Trend following, more easily understood, more common allocation for investors. Clearly, trend following is simply about exploiting price momentum in markets and trying to follow that momentum wherever it takes you, again, across equity indices, across fixed income and rates, across currencies, across commodities. Trend following is a strategy that I quite like, but I acknowledge is difficult for investors to hold. So we all know that momentum exists in markets. We know there's a crowding effect. We know that asset allocation decision makers are slow moving and will follow prices. It's been shown time and time again, academically and in practice, that momentum exists and can be exploited in markets. And yet, most people are underinvested in trend following. And that's because trend following has a relatively low Sharpe ratio on a standalone basis and can go multiple years without making any money and comes with high volatility. So as a single line item, it can be difficult to explain to an investor why you're invested in this noisy thing that can go multi-years without generating a return. But the reality is trend following will often generate all of its 3 or 4 years of return in a short, sharp 6-month period. And you can see that the index was up 29% in the first half of this year, really differentiating it as a strategy in a particularly difficult market for investors. But it was, again, a bit like short-term trading, a strategy that perhaps hadn't seen as much interest prior to this year because people were more focused on long-biased investing. Where's trend following made its money this year? Well, again, I've got the US 2-year yield as one example up there on the top right-hand side. A very clear price trend. Should be no surprise that trend following has been aggressively short US short-term interest rates in the front end of the US curve this year. Continues to be short today. Similarly, UK yields have been a popular short, both at the short and the long end. At times we've been short Germany, we've been short JGBs as well. But also, more recently, the dollar has been a P&L driver for us too. So general bias towards the dollar against a wide basket of currencies. Today, some of the more popular shorts are the pound, the euro, Singapore dollar, the Indian rupee, the Korean won, but tends not to be too concentrated against any single currency. And the dollar strength, which we acknowledge to some extent is driven by the interest rate differential and the Fed leading the way, has been another driver of P&L for trend following. We did actually reduce our risk in trend following in the midpoint in June when yields reached their kind of peaks at that point in time. Underlying market volatility had picked up substantially. Some of our macro trades were relatively correlated to some of the momentum positions that trend following had been taken. And one of the things we try to do is anticipate where risk is grouping or becoming too binary in our overall portfolio and where strategies are cross-correlating. And so some of the, I've put at the bottom left there the asset class exposures for trend following, so you can see where it's been net long and net short. You can see the net short in the dollar, you can see the net short in rates, but you can see the interest rate shorts gradually coming off over the last couple of months, and that's partly because we cut risk in the underlying strategy itself. However, duration shorts have increased somewhat again over the last month or so, and trend following is having another good month this month, and is making money both in the dollar and interest rate shorts. All of that said, things have moved a long way this year, and a lot of the hiking cycles around the world are priced now in a way that they needed to be priced and weren't priced at the start of the year. And so I don't necessarily think it's the case that there's the easy win that we saw in the first half of simply being short interest rates, being short bonds on a global basis, being long the dollar. I think what you're seeing now is a much more nuanced market where certain central banks are arguably at or ahead of the curve, but other central banks are still significantly behind the curve. Underlying economic fundamentals across countries are quite different in terms of growth and inflation trajectories, stages in fighting the pandemic, import-export balances, currency weakness, currency reserves. And all of that means that from here, you might be in more of a relative value space where you might want to pick winners and losers across countries from a macro perspective. And that feeds into the hands of global macro managers. And again, global macro, you can see on the bottom right-hand side here, has had a pretty solid year. The HFRI Macro Total Index, which goes across both discretionary and systematic managers, is up about 8.5%. Similarly, in our portfolio, we've seen some very big wins, actually. We've made quite a lot of money being long the US dollar against the euro, against the Australian dollar, against the yen, and at times against the pound. And those have been driven by differing growth across the US versus the European and UK in particular economies, and the widening yield differential earlier in this year as the Fed was repriced. I think that for global macro to work, different economies at different stages in the cycle is quite a good place to be. And I think the profile is going to be a little different because it was about outright data, outright direction earlier this year, effectively being short rates, maybe being long dollar, whereas now I think it's going to be about picking your countries, understanding what central banks are doing on a case-by-case basis, and trying to identify the pockets of value and the pockets of overvaluation to put both long and short trades on. And so I would say that our global macro book today does remain long the dollar, which again has worked well this month and year to date. We are still somewhat short duration, but it's a bit more of a mix than it was earlier in the year, and certainly the outright position has come down. So that leads me on to how all this is put together. I've given you a snapshot of our portfolio here, so you can see the different weightings across strategies. Our philosophy is that although I've outlined some of these strategy areas and talked about them being potentially attractive or unattractive, it is very difficult to forecast which alpha strategies are going to work or not work over a 3 to 6 month period. We find we're very good at explaining ex post why it was a good market or a bad market for underlying managers and strategies, but to try to anticipate the drivers is more problematic. So our philosophy is to say that we have 6 core strategies in the portfolio that you can see there. We've talked about 4 of them. We expect all of them to have positive long-term returns with low correlation to equity and fixed income. We also expect all of them to be pretty uncorrelated to each other. We think they're hard to time, so we like to allocate risk relatively equally across those different strategies in our portfolio so that we can hold them and benefit from the long-term Sharpe ratios. And again, going back to my earlier example of trend following being quite hard to hold, if it's a 15% weighting in the portfolio, it's there when we need it, but when it's not working, there are plenty of other things around it that hopefully can generate returns so that we're able to hold it. So that gives you an idea of what's in the portfolio today. I'm very happy to go into more detail about any of the underlying strategies, but I realize we're getting somewhat tight on time. They say that this is a particularly valid period, I think, for absolute return as opposed to relative return. You can't eat relative return. You probably do want to eat your lunch, so I'll open up for questions.
Hello everyone, and thank you for joining us for the first day of this year's virtual think tank event. My name is Natalie Harrison, and I am the Global Fund Specialist who, together with my colleague Nkazana Nzima, are responsible for distributing Momentum Global Investment Management's international investment solutions right here in South Africa. We are so humbled that so many of our financial advisor partners from across the globe join us today to gain independent insights from top international asset managers on how to invest for resilience. And our trust today did not disappoint. Even after attending the live event in London earlier this month, it has been great to revisit the insights shared as we navigate this year of transition and uncertainty. We had JP Morgan outline the impact of the European energy crisis and how it is expected to lead to economic contraction in the region, as well as Prusik Investment Management highlight the investment opportunity that Hong Kong equities provide for Asian equity income investors. Then the growth versus value debate was addressed through two of our specialist equity managers held within our flagship Momentum Global Equity Fund, namely Jennison on the growth side and Hotchkiss and Wiley on the value side. Both managers built great cases for the use of value and growth within investment portfolios and just reaffirms why we at Momentum Global Investment Management continue to blend investment styles to smooth the investment journey through the cycle. And then finally, with the traditional 60-40 equity bond portfolio having its worst performance on record year to date, the use of alternative diversifiers has become even more relevant. And Neuberger Berman covered the various uncorrelated investment options that they have available to investors. And we do use some of these solutions within our various funds within Momentum Global Investment Management. So to wrap up, just a reminder that the virtual platform that you have access to today will remain open until the end of October if you would like to view any of the presentations again. During this time, South African and UK delegates will be still able to earn CPD points for any of the content viewed. After October, all the videos will be available in various regions, such as the Momentum Investments events page, the Global Matters portal on momentum.co.za, as well as the MGIM website on momentum.co.uk. If you need any guidance on where to find those presentations, please do chat to your Momentum representative. So with that, the first day of our 21st Annual Think Tank Conference has come to an end. Thank you again so much for joining us today. We really look forward to seeing you virtually tomorrow, where you'll get further insights from some of the other external investment managers we use within our engine portfolios, including Schroders Capital, IKEA Investment Management, and Alvarium Securities. Thank you again for joining us.
Good morning, everyone, and a very warm welcome to Think Tank 2022. We're proud to have built and maintained such a strong following and reputation for this conference over the years, demonstrated by some clients having attended almost every one. We look forward to celebrating these milestones with you this evening at the very special dinner venue of St Paul's Cathedral.
This is a truly remarkable time. I mean, we have gone through one crisis after another. Trying to pin down forecasts and an outlook is incredibly difficult.
And there's great opportunity right now. And I'll say for growth stocks in particular, Europe is cheap. It's actually has some really good ones that are pretty attractively valued.
It's been a particularly interesting year for alternative investing, and it's been quite a strong year for the portfolio.
Portfolios that we are building for the next 10 years will probably have to be very different from the way we built portfolios over the last 40 years.
I guess I'd sum up my highlights in three key things. Firstly, just the quality and the breadth of the speakers over the course of the last couple of days. Some of the new thinking and new ideas that came from those presentations.
I think one of the highlights was just to mingle again with fellows from abroad and also to get insights from outside South Africa in terms of world economy, what we can expect going forward, and also the challenges that we see in Europe as well as the US in the future.
Definitely hearing from advisors all over the world about the challenges facing their clients.
You have to be extremely picky, extremely fussy in whom you choose to back, and if you actually do, back good quality people, good quality entrepreneurs, then the investment success comes with it.
I must say, away from the conference, our function at St Paul's last night was amazing, But then the content generally was pretty good. And I really learned a lot and have so much to take back to my investors.
And Paul's cathedral tour was super special. Having dinner in an ancient building and experiencing an atmosphere was definitely a highlight, and I will remember that for quite some time.